Want to know how you can gain access to capital to jumpstart your journey to entrepreneurial success? For entrepreneurs who are just starting out or those who have been in business for years, Minority Business Access is your podcast. Welcome to our show, where we will guide you in avoiding the pitfalls and thriving in your chosen business. Now, onto the show with your host, Solomon Ali.
I'm glad to have everyone back to MBA, Minority Business Access. We're going to get right back to it about how to grow a business with William Ackman. Again, I think the guy's done an extremely awesome job in explaining everything that he's explaining. And so I can't do it any justice, but we're going to try to give a few points here and there so we can break it down so it can be a little simpler for everyone to understand and get it. I'm really excited about it and very jazzed, and I hope you guys get jazzed and excited about it as well. William Ackman is one of the great guys who is actually running a hedge fund and doing really amazing things. And so when we pick people to be like guys, let's pick those people that we can inspire to grow, to develop, to push ourselves so that we can aim for the next level. And so he's one of the people that, if I'm going to look around, he's going to be on my list, like with Warren Buffett, Carl Icahn, and Robert Smith, those kind of guys and things like that. That's just out there doing their thing, making a difference in the world and stuff like that. So he broke it down. He did an awesome job. So please follow me. Let's look at it. Let's try to talk about it a little bit. Let me point out some things from what I see, because me pointing out the things that I see at the level I'm at will help you to achieve getting to the level where I am a little faster, a little sooner. And I'm inspiring to get to his level. So let's work together. Let's help one another. Let's try to get this done. Growing a business.
Let's look at the cash flow statement. So as the business becomes more and more profitable, we generate more and more cash. And the cash builds up in the company. We go from $500 of cash in the company to over $2,000 of cash over the period. The balance sheet. Again, the starting balance sheet had shareholders' equity of $1,490, but as the business becomes more profitable, the profits add to the cash, they add to the assets of the company. Our liabilities have not changed, and the business continues to build value over time. So again, by the end of year 5, we've got $4,000 of shareholder equity, and that's almost 3 times what it was when we started.
Now, do you see the power of growing a business, whether it's organically, just by adding new lemonade stands, or if it's just growing by acquisitions? The power in over time and consistency. A lot of you have heard me say time and time again, when you invest, when you do something, you're doing it for the long haul. It's not a short-term gain. So don't be like some of my day traders and things of that nature out there thinking that they're going to hit a home run. You're just going to make a few dollars. You're going to make pocket change, people. If you're looking to make the real money, again, if you're looking to make the real money, if you want real money, you're making long-term investments. You're making investments in something that you understand. And as long as you understand it, you'll be comfortable in waiting it out. But see, there's something else that comes with that. And you know what it is? We've said this time and time again. What is it? Due diligence. Do your homework. Understand the industry. Know what's going on in the industry. Believe in yourself and the work that you've done, okay? That will give you the confidence to stand fast and stand by the position that you have made. So, guys, you got to do this. And you can't just wish it. It's not going to happen by osmosis. It doesn't work that way. It takes a lot of work. And sometimes you're not going to be able to see the results of your work. It's going to look like it's failing. The stock could be down or the investment could be going bad and looks really terrible. And you may have to double down on it, whatever you want to call it or phrase you want to use. But sometimes that's what you have to do. But when you've done the work, you've done the homework, you understand the industry, you understand the vendors, the customers and everything in the industry, you move with confidence and a boldness, and you're able to hold your position with strength.
Now, is this a good business or a bad business? How do we think about whether it's good or bad? One thing to think about is what kind of earnings are we achieving compared to how much money went into the company? Now, this is a business that we valued at $1,500 when we started. Someone put up $500 for a third of the company. We give it a $1,500 value, but at the end of year 5, it's earning over $1,500 in earnings. So that's over 100% return on the money that we put into the company. That's actually quite a high number. We spent $2,100 in capital building lemonade stands, and we earned $2,336 in year 5 on the capital we invested. That's over 100% return on capital. That's a very attractive return. Earnings have grown at a very rapid rate, 155% per annum. This is really a growth company. And our profitability has gone from 1.3% to 28.6% by year 5. That sounds pretty attractive, and it is.
Guys, in other words, this is an awesome, awesome business to invest in. That's what you're looking for. And what he's focusing on is the same things that you will need to be focused on. You have to know your numbers. You manage and grow your business by understanding your numbers. You manage your people. We call them key performance indicators. Get accustomed to hearing that word, key performance indicators. It's tying people into the performance, okay? And each person plays a critical role in the performance of your company, driving and moving us towards the bottom line. So please remember that in the future. Key performance indicators.
So let's look at the person who put up the loan. Well, that person put up $250, and the business has been profitable. We've been able to pay them their interest of 10% a year, $25 a year. And they're happy because they put up $250. They're getting a 10% return on their loan. And the business is worth well more than $250. We've got more than that in cash. As a result, they're in a safe position, but they've only made 10% of their money. Now let's compare that with the equity investor, the person who bought the stock in the company. That person earned $1 a share in year 5 versus an investment of $1 a share. So he's earning over 100%, or about 100% return on his investment, versus only 10% for the lender. So who got the better deal? Well, obviously, the equity investor. Now, why do they have the right to earn so much more than the lender? The answer is they took more risk. If the business failed, the lender is entitled to the first $250 of value that comes from liquidating the company. So if you sell off the lemonade stands and you only get $250, the lender gets back all their money. They're safe. They got their 10% return while the business was going. They got back their $250. But the equity investor, the person who bought the stock, is wiped out because they come after the lender.
Okay, we're going to stop. I'm going to go back just a little bit, and then we're going to go over those 2 pages and really talk about that difference between the equity investor and the debt investor, right? Or what we call the debt, which is the lender, all right? The lender is always the bank. Well, let me ask you, do you guys feel we need to go back, or would you want me just to talk about it? What do you think? What say you? I'm going back. How about that? We're going to make this easy. Now, let me see if I can work this nice little beautiful thing. I'm going to have to put on my eyes so I can see. And here we go, here we go, here we go.
There's senior debt, there's junior debt, there's mezzanine debt, there's convertible debt. But bottom line, it's all debt. It comes in different orders of priority in a company. And the rate you charge is inversely related to your security. So the better the security and the less risk, the lower the interest rate you're entitled to receive. The more junior the loan, the higher the interest rate you're entitled to receive. But you can avoid the complexity. All you need to think about is debt comes first. It's a safer loan, but your profit opportunity is limited. Now the equity also, there are varying forms. There's something called preferred equity or preferred stock. There's common equity or common stock. And again, stock and equity are basically synonyms. There are options, but really not worth talking about today. The important point is that the equity gets everything that's left over after the debt's paid off. So it's called a residual claim. Now, the good thing about the residual claim is that business grows in value You don't owe your lenders anymore, but all that value goes to the stockholder. So the question is, why was the lender willing to take only a 10% return when the equity earned a much higher rate of return? And the answer is, when the business started, there was no way of knowing whether it would be successful or not. And the lender made a bet that if the business failed, well, they could sell it to the lemonade stand. It cost $300 to make it. They would have some lemons, some lemonade. Even if they sold at a much lower price than the dollar they originally projected, the lender felt pretty comfortable that they'd get their money back. Whereas the stockholder is really taking a risk. They were betting on the profitability of the company, and they were taking a risk that if it failed, they would lose their entire investment. So they were entitled to get a higher return, or had the potential to have a higher return in the event the business was successful. So let's talk about risk. A lot of people talk about risk in the stock market as the risk of stock prices moving up and down every day. We don't think that's the risk that you should be focused on. The risk you should be focused on is if you invest in a business, what are the chances that you're going to lose your money, that there's going to be a permanent loss? When you're thinking about investing your own money, when you're thinking about one investment versus another, don't worry so much about whether the price moves up and down a lot in the short term. What matters is, ultimately, will you get your money back? Will you earn a return on your investment?
You hear that? Don't worry whether the price move up and down in the short term. Isn't that what I've been preaching? You invest for the long term. I'm a lender. I'm a private equity guy. I invest in stocks, okay, but here's how I invest in a company. I want you to understand this because a lot of you get all of this confused. What's the difference between debt and equity? Debt is normally a creditor's position. Equity is ownership position. Okay, let's say it together. Debt is a creditor's position. Equity, ownership position. Debt, we don't share in the risk of what goes on in the company. Normally, if you had to file bankruptcy, under the bankruptcy rules and everything, the creditor will be getting paid back their monies first. If there's anything left, okay, it will be divided amongst all the equity holders. So some say, well, Solomon, why do you like, as a private equity guy, why do you like being the bank and just loaning money rather than doing a different model like some of the other private equity? I don't like risk. I don't. Okay. So when I invest in a company, I invest as a lender. I am going to give you, let's say, $100. In exchange for my $100, you're going to give me a security note. Okay. And it's going to be a contract between the two parties, and the two parties, what we're agreeing on is when that money's going to be paid back, how that money is going to be paid back, and there's always going to be a clause in there so that you don't have to pay me back in cash. You may be able to pay me back in equity. So that's one way that you're going to pay me back. Okay. The other way is when I loan you that money, I may say that I am going to take a 10% ownership in your position. I am still going to be a creditor that you're going to have to pay me my $100 back over the next 3 to 5 years. And while you're paying me back, there will be an interest rate attached to that. But I am also going to take a certain percentage. All right. Understand this. A certain percentage of the revenue that's coming in. So let's say that percentage is 20% of the revenue that's coming in. Okay. So that would be my deal in my structure. All right. Because why would I invest money in your company and take all the risk? And what you're going to bring is what? You're going to bring the human labor, right? So if that's what you're bringing, I'm taking the risk. So we're risking our money and you're bringing the human capital. So you're going to do the work and be getting paid along the way. So that's my way of kind of balancing it out. Now, in the future, what I'm hoping and praying is that we're successful. Now, this lemonade company right here that Bill is showing, I would take that public in a heartbeat, seeing a company that's doing 100 and something percent in its numbers and stuff and showing that type of growth. That's phenomenal. Okay. Which means I would have a good stock and I would be like, hey, Bill, you don't have to pay me back in cash. How about we just convert that to equity?
Equity investors sort of think about things similarly. So the higher the valuation, the more risky the business, the higher the rate of return the equity investor is going to expect. And the lower the risk business, the lower the return the equity investor is going to expect. And equity investors don't get interest the same way a lender does. What equity investors get is they get the potential to receive dividends over the life of a company. Let's talk about raising capital. You started this lemonade business. Now, the point of this was to make money in the first place. Business is doing very well, yet as having started the business, coming up with a name and the concept, hired all the people, I've made nothing. Right? So the business has grown in value, but where's my money? I need money to buy a car, for example. So I want to buy a car for $4,000. What are my choices? What can I do? Well, we've taken all the cash the business has generated, we've reinvested in the business. Now, the good news is we've taken all that money, we've been able to use it to buy more lemonade stands, and these lemonade stands are more and more productive, and it's grown the value of the business faster and faster.
Listen, I'm going to have to pause it real quick, and I got to cover this. You guys heard what he just said? They took all the cash, and this is what entrepreneurs you have to learn. They took all of their cash from the business, from the one lemonade stand, reinvested it back into the business. Then they took all the cash from the two lemonade stands and reinvested it back in the business. And then from the third lemonade stand and reinvested it back into the business. So guys, sometimes that may mean that you got to go get a second job out there, work at night, okay, so that you can reinvest all of your resources back into the business. That may mean that you have to bring on other partners, okay, that's willing to do and provide human capital, okay, which means doing some of the work so you guys can keep all the resources within the business to grow, to generate those type of returns. So that's what we're talking about here. And that's what I want you to understand. Play this over and over and over again. It's very important to grab this, digest it, and use it, okay? And what he's talking about, the management team is not known, don't have a track record and being successful in doing what they're doing. A startup business, no historical numbers, they're just starting, it's a dream.
So number one, how do you avoid losing money? What are good places to invest? Well, my first piece of advice is, despite the story about the lemonade stand, I'd avoid investing in lemonade stands. I'd avoid investing in startup businesses where the prospects are not very well known. Because again, you don't need to make 100% a year to have a fortune. You just need to invest at an attractive return, 10, 15% over a long period of time. Your money grows very significantly. So how do you avoid the riskiest investments? My advice would be to invest in public securities, invest in listed companies, companies that trade on the stock market. Why? Because those businesses tend to be more established. They have to meet certain hurdles before they go public. The stocks are liquid, so you can change your mind if you want to sell. If you invest in a private lemonade stand, it's hard to find someone to take you out of that investment unless that business becomes fabulously profitable. So that's piece of advice number one. Invest in public companies.
I second that. Invest in public companies. Hear, hear.
Number two, you want to invest in businesses that you can understand. What I mean by that is there are lots of businesses that you deal with in the course of your day in your personal life, whether it's a retail store that you know because you like shopping there, or it's a product, your iPad, or that you know you think is a great product. But you have to understand how the company makes money. If the business is just too complicated, you don't understand how they make money. Even if they've had a great track record, I would avoid it. A lot of people thought Enron was an incredible business because it appeared to have a good track record, but very few people understood how they made money. It was good to avoid it. Another very important criteria is you want to invest at a reasonable price. It could be a fabulous business that's done very well over a long period of time, but if you pay too much for it, you're not going to earn a very good return. The last bit is that you want to invest in a business that you could theoretically own forever. If the stock market were to close for 10 years, you wouldn't be unhappy. What do I mean by that? Now, again, if you're going to compound your money at a 10 or 15% return over a 43-year period of time, you really want a business that you can own forever. You don't want to constantly have to be shifting from one business to the next. And what are businesses that you can own forever? Well, there are very few that sort of meet that standard. Maybe a good example is Coca-Cola, right? What's good about Coca-Cola is it's a relatively easy business to understand. You understand how Coke makes money, right? They sell a formula or syrup to bottlers and to retail establishments, and they make a profit every time they serve a Coca-Cola. People are going to drink a lot of Coca-Cola for a very long period of time. The world's population is growing. They sell in almost every country in the world. And each year, people drink a little bit more Coca-Cola. So it's a pretty easy business to understand. And it's also a business that I think is unlikely to be competed away as a result of technology or some other new product, right? It's been around long enough People have grown used to the taste. Parents give it to their children, and you can expect that it'll be around a long period of time. I think that's one good example. Another good example might be McDonald's. You may not love McDonald's hamburgers, but it's a business that's been around for 50 years. You understand how they make money. They build these little boxes. They rent them to the franchisees. They charge them royalties in exchange for the name, and they sell hamburgers and French fries. And you know what? People have to eat. It's relatively low-cost food. The quality is pretty good, and they continue to grow every year. So I think the consistent message here is try to find a business that you can understand, that's not particularly complicated, that has a successful long-term track record, that makes an attractive profit, and can grow over time. So what are the key things to look for in a business, as I say, that lasts forever? We want a business that sells a product or a service that people need and that is somewhat unique, and they have a loyalty to this particular brand or product, and that people are willing to pay a premium for that. I mean, another good example might be a candy business. While people are willing to buy generic versions of many kind of food products, flour or sugar, they don't need to have the branded product. When it comes to candy, people don't tend to like the Walmart version or the Kmart version. They want the Hershey chocolate bar or the Cadbury chocolate bar or the See's candy. They want the brand, and they're willing to pay a premium for that.
And guys, we've talked about this before, solving someone's problem. That's the business that lasts forever. When you can identify a problem that either customers have or business to business where you can solve a problem, that will give you the longevity. That will give your business the longevity. Solve someone's problem.
And so that's, I think, a key thing. You want the product to be unique. You don't want it to be a commodity that everyone else can sell, because when you sell a commodity, anyone can sell it, and they can sell it at a better price, and it's very hard to make a profit doing that. If you're investing for the long term, you want to invest in businesses that have very little debt. In our little example before, we talked about our lemonade stand. There's $250 worth of debt. That didn't put too much pressure on the lemonade stand company, but if it had been $1,000, we hit a rough patch, the business could have got out of business for failure to pay its debts. The shareholders could have been wiped out.
Now, what he's talking about, investing in businesses with very little debt and investing for the long term, is when you're investing and you're not carrying a lot of debt, the advantage is it gives you access and allows you to have access to more capital.
So if you can find a company that can earn attractive profits, that doesn't have a lot of debt, where they generate vastly more profits than they need to pay the interest on their debt, that's a safe place to put your money over a long period of time. You want businesses that have what people call barriers to entry. You want a business where it's hard for someone tomorrow to set up a new company to compete with you and put you out of business. I mean, like going back to the Coca-Cola example. Coca-Cola has such a strong market presence. People have come to expect when they go to a restaurant, they can ask for a Coke and get a Coke. It's very hard for someone else to break in. Now, of course, there's Pepsi and there are other soda brands, but Pepsi's been around a long time. Coca-Cola and Pepsi have continued to exist side by side over long periods of time. So when you're thinking about choosing a company, make sure that they sell a product or a service it's hard for someone else to make a better one that you'll switch to tomorrow. You also want businesses that are not particularly sensitive to outside factors, so-called extrinsic factors that you can't control. So if a business will be affected dramatically if the price of a particular commodity goes up, or if interest rates move up and down, or if currency prices change. You want a company that's fairly immune to what's going on in the world. And I'll use my Coca-Cola example. I mean, if you think about Coca-Cola, it's a product that's been around probably 120 years. Over that period of time, there have been multiple world wars, development of nuclear weapons, all kinds of unfortunate events and tragedies and so on and so forth. But each year, the company pretty much makes a little bit more money than they made before, and they're going to be around. And you can be confident, based on the history, that this is a business that's going to be around almost regardless of whether interest rates are at 14%, whether the US dollar is not worth very much, or the price of gold's up or down. Those are the kind of companies you want to invest in the long term. Businesses that are extremely immune to the events that are going on in the world. Another criteria, if you think back to our lemonade stand company, as we grew, we had to buy more and more lemonade stands. Now, those lemonade stands only cost $300 each. But imagine a business where every time you grew, you had to build a new factory to produce more and more product. And those factories were really expensive.
This is the keys to investing successfully right here. These are the keys to investing successfully.
Well, that company might generate a lot of cash from the business, but in order to grow, you're going to have to just reinvest more and more cash into the business. The best businesses are the ones where they don't require a lot of capital to be reinvested in the company. They generate lots of cash that you can use to pay dividends to your shareholders, or you can invest in new high return, attractive projects. I guess the last point I would make is that you're going to invest in public companies. It's probably safest to invest in businesses that are not controlled.
I like public companies because public companies have lots of owners. They have to follow the regulations and all the rules. And so you're not stuck like in a private company at someone's whims on what they may want to do or if they've had a bad day or things of that nature. There's some rules and regulations that they must follow. The exciting thing that what we're talking about here at MBA today as we talk with and listen to Mr. William Ackman is this. We're talking about how to be successful as an entrepreneur, how to invest in a company, what as an entrepreneur you should be looking at, and why you should actually be looking at that as an entrepreneur. Guys, here's the thing. Business is tough. It's more than a notion. My ex-wife used to say that all the time. It is more than a notion. It is hard as crap. If you're thinking that you're going into business and it's only going to be all of this money and things of that nature, and you're telling other people what to do, don't go into business because it's nothing like that. It's problems. It's problems in raising capital. It's problems in getting people to buy into your vision. It's problems. Because as you know, when we're dealing with people, what are we dealing with? People who have their own will, their own expertise and knowledge, their own opinions. And we have to be able to motivate them, get them to see our opinions and get it to see our vision of where we're going and why it should go that way. And that's very difficult sometimes. And if you're not the kind of person, we talked about this before again, you got to hire the right people. You got to stay in your lane. You can't be afraid or think that you're going to try to save $1 because this consultant or this person is too expensive. What you got to sit back and say is, you know what? I can't afford not to bring in the consultant. I can't afford not to bring in the right people who can do the job for me that I can't do so that we can get this done. That's how you stay in business, okay? See, I wouldn't recommend any of you go and try to raise your own capital. And I'm going to say it this way. I would recommend you call a guy like Solomon to go raise your capital, who understands what it means to raise capital, who understands some of the principles, who's accustomed to working with the attorneys and things of that nature and negotiating on the other side so that you get the best deal that you possibly can get. And yes, you have to pay a guy like me 10% or 15% for arranging all that. But a guy like me also helps you to put all the books and the records together by working with your professionals and getting all that together so that, you may not have known yesterday what you needed and what it needed to look like. But now we can put it together the way it needs to look so that you have a better chance of being successful in raising the money. Listen, guys, I want to thank you so very much for tuning in to Minority Business Access. It has been a blast. I mean, a total blast in talking to you guys and sharing the William Ackman presentation with you. We're going to come back again. If you like this presentation and what we're talking about right now, maybe you don't like me, but give me that thumbs up because you like the information that you're getting. And for those of you who are like, well, the information is so-so, but you just fell in love with me and you like me, give me a thumbs up so that we can keep this going and everything and kind of just share wisdom and knowledge so that you don't have to go through a learning curve. Thank you all so much, so very much for coming in and tuning in to Minority Business Access. Thank you for coming back to Minority Business Access. Very pleased to have everyone here today at Minority Business Access. We're going to actually finish up. This has been so exciting talking about the things that William Ackman has been doing and things like that. He put this awesome presentation together that I think is extremely helpful to all entrepreneurs, anyone thinking about being in business. And it helps you to remember that it's more than a notion. And so people, let's go ahead and get right back into it. We're coming to the close now of it. And again, I'm just so thrilled and excited to be here.
Anyone can sell it, and they can sell it at at a better price, and it's very hard to make a profit doing that. If you're investing for the long term, you want to invest in businesses that have very little debt. In our little example before, we talked about our lemonade stand.
Now, we're going to talk about that a little bit. Keep in mind what I said. If you give up ownership, okay, you dilute it, bring your stock price down in many cases. If you are borrowing money, it's cheaper to borrow money, but you must be able to create the value when you borrow that money to build your business and scale it, whatever you're going to do. It's kind of like saying, okay, I'm going to borrow the money to build a house, but all I do is buy the land, but I never build the house. So the appreciation is never actually there. So look at it from that standpoint.
There's $250 worth of debt. That didn't put too much pressure on the lemonade stand company, but if it had been $1,000, we hit a rough patch, the business could have got out of business for failure to pay its debts, the shareholders could have been wiped out. So if you can find a company that can earn attractive profits, that doesn't have a lot of debt, where they generate vastly more profits than they need to pay the interest on their debt, that's a safe place to put your money over a long period of time. You want businesses that have what people call barriers to entry. You want a business where it's hard for someone tomorrow to set up a new company to compete with you and put you out of business. I mean, like going back to the Coca-Cola example. Coca-Cola has such a strong market presence. People have come to expect when they go to a restaurant, they can ask for a Coke and get a Coke. It's very hard for someone else to break in. And of course, there's Pepsi and there are other soda brands, but Pepsi's been around a long time. Coca-Cola and Pepsi have continued to exist side by side over long periods of time. So when you're thinking about choosing a company, make sure that they sell a product or a service it's hard for someone else to make a better one that you'll switch to tomorrow. You also want businesses that are not particularly sensitive to outside factors, so-called extrinsic factors that you can't control. So if a business will be affected dramatically if the price of a particular commodity goes up, or if interest rates move up and down, or if currency prices change, you want a company that's fairly immune to what's going on in the world. And I'll use my Coca-Cola example. I mean, if you think about Coca-Cola, it's a product that's been around probably 120 years. Over that period of time, there have been multiple world wars, development of nuclear weapons, all kinds of unfortunate events and tragedies and so on and so forth. But each year, the company pretty much makes a little bit more money than they made before, and they're going to be around. And you can be confident, based on the history, that this is a business that's going to be around almost regardless of whether interest rates are at 14%, whether the U.S. dollar is not worth very much, or the price of gold's up or down. Those are the kind of companies you want to invest in the long term. Businesses that are extremely immune to the events that are going on in the world.
And keep in mind now, all businesses have volatility and they fluctuate based on what's happening in the market. So please keep that in mind. But what you want to try to do is find the business that's recession proof. And you can find that. Like we spoke before, liquor sales, tobacco, they tend to have sales stay the same, or if not even grow a little bit consistently. And that's based on historical information on what's happened historically during recessions and depressions in the past.
I guess the last point I would make is that you're going to invest in public companies. It's probably safest to invest in businesses that are not controlled. A controlled company is kind of like our lemonade stand business that we took public. The problem with a controlled company, unless the controlling shareholder is someone you completely trust, unless there's someone that has a great track record for taking care of so-called minority investors, the non-controlling shareholders, it can be a risky proposition to invest in that business because you're at the whim of the controlling shareholder. And even if the controlling shareholder today is someone that you feel comfortable with, there's no assurance that in the future they might sell control to someone else who's not going to be as supportive of the shareholders of the business. So it's not that you can simply have a profitable business and a business that has done well. You have to make sure that the management and the people that control the business think about you as an owner and are going to protect your interests. So these are some of the key criteria to think about.
Here's the thing. I'm going to keep it short. It's very risky investing in private ventures because the owners basically are the key in the brand, and they can cause you to make money or lose money or just walk away and your money's all invested in it and it can be done. Well, the same if it's a publicly traded company. And I want you guys to listen to what I'm saying. If you have a publicly traded company that you're investing in and the largest shareholders is management, you want to think twice about that because management could decide one day that pretty much to take the company in the direction they wish to take it in that may not be in the best interest of all the shareholders.
Now, when are you ready to start investing money? My guess is you're a student, you probably have student loans, perhaps you even have some credit card debt, you're going to graduate, you're going to get a job. So you don't want to jump right in and, while you have a lot of debt outstanding, start investing in the stock market. The stock market is a place to invest when you've got you have money you can put away and you won't need for 5 years or maybe 10 years. So if you're paying relatively high interest rates on your credit cards, you definitely want to pay off your credit cards first before you think about investing in the stock market. Your student loans are probably lower cost than your credit cards, but again here, my best advice would be, if your student loans are costing you 6 or 7%, well, if you pay them off, it's as if you earned a guaranteed 6 or 7% return. And you're just better off getting rid of your credit card debt and even your student loan debt before you commit a material amount of money to the stock market. Even once you've paid off your credit card debt, perhaps you've paid down your student loans, you want to have enough money in the bank so that even if you were to lose your job tomorrow, you've got a good 6 months, maybe even 12 months of money set aside. Let's talk a little bit about the psychology of investing. So we've talked about some of the technical factors, how to think about what a business is worth. You want to buy a business at a reasonable price. You want to buy a business that's going to exist forever, that has barriers to entry, where it's going to be difficult for people to compete with you. But all of those things are important, and a lot of investors follow those principles. The problem is that when they put them into practice, and there's a panic in the world, and the stock market's heading down every day, and they're watching the value of their IRA or their investment account decline, the natural tendency is sort of to do the opposite of what makes sense. To be a successful investor, you have to be able to avoid some natural human tendencies to follow the herd. When the stock market's going down every day, your natural tendency is to want to sell. When the stock market's actually going up every day, your natural tendency is to want to buy. So in bubbles, you probably should be a seller. In busts, you should probably be a buyer. And you have to have that kind of a discipline. You have to have a stomach to withstand the volatility of the stock market.
In other words, if everyone's buying it, it's probably a signal to wait. If everyone is selling, it may be a signal to buy.
Key way to have a stomach to withstand the volatility of the stock market is to be secure yourself. You've got to feel comfortable that you've got enough money in the bank that you don't need what you have invested unless for many years. That's a key factor. Number two, you have to recognize that the stock market in the short term is what we call a voting machine. It really represents the whims of people in the short term.
Guys, do not take money from your credit cards or borrow money from family and friends to invest in a stock, okay, or to invest in a business. Save up your own money, do joint ventures. If I'm going to do an investment and I have no money and I want to invest in a business, I may go to 5 or 6 of my friends and we do a joint venture together, creating one entity, and that one entity would go and invest in that company. But I would not borrow money off of my credit cards, and I would not borrow money from my family and friends, because there's no assurance that you'll be able to make money or get that money back.
Let's say this is just not for you. I don't want to buy individual stocks. It just seems too risky. I don't have the time to do my own research. What are your alternatives? Well, your alternatives are to outsource your investing to others. You can hire a money manager, or you can hire a group of money managers. And there are a couple of different alternatives for a startup investor. The most common alternative are mutual fund companies. So what's a mutual fund? A mutual fund is I guess technically it's a corporation, but where you buy stock in this corporation and the manager selects a portfolio of stocks. So what they do is they pool together capital, money from a large group of investors. So let's say they raise $1 billion, and they take that money and they invest in a diversified collection of securities. Now, the benefit of this approach is that with a tiny amount of money, you can even less than $1,000, you can buy into a diversified portfolio managed by a professional manager who's compensated to do a good job for you investing in the market. So mutual funds are a good potential area for investment. The problem is there are probably 7,000, 8,000, maybe 10,000 different mutual funds, and some are fantastic and some are not particularly good. So you need to do research to find a good mutual fund manager in the same way that you need to find individual stocks. So it's not just the easy thing of just invest in mutual funds. So here are a few key success factors in identifying a mutual fund or a money manager of any kind to select. Number one, you want someone who has an investment strategy that makes sense to you. You understand what they do and how they do it. They're not appealing to your insecurity by using complicated words and expressions that you don't understand. If they can't explain to you in 2 minutes what they do and how they do it and why it makes sense, then it's a strategy you shouldn't invest in.
And I would agree with that. If you don't understand it and they can't articulate it to where you understand it, walk away.
Number two, and this is not necessarily in this order, this probably should be number one, is you want someone with a reputation for integrity. If you're starting out, you probably want to invest in some of a mutual fund that's sponsored by some of the larger mutual fund complexes, as opposed to a tiny little mutual fund that's privately by a mutual fund company that you've never heard of. There's some benefit in the larger institutions. You can be more confident that they're not going to steal your money. You want an approach where the investor invests money on the basis of value. And now this sounds kind of obvious, but value investing has a very long-term track record. And now there are other kinds of investing, including technical investing, where people are betting on stocks based on price movements. But I highly recommend against those kind of approaches. So you want someone who's making investments where they're buying companies based on their belief that the prospects of the business will be good and that the price paid relative to what the business is worth represents a significant discount. We started with a little lemonade stand company, and the purpose of that was to give you some of the basics in how to think about a business, where the profits come from, what revenues are, what expenses are, what a balance sheet is, what an income statement is, how to think about what a business is worth, how to think about what the difference between a good business is versus a bad business.
This has been really awesome. It's been totally awesome. What I want to do, that's the end of it. This is where we are. This is how you make investments. This is how you look at it. I want to thank everyone so very much for joining and tuning into Minority Business Access. It's been a blast. I want to thank William Ackman for this beautiful presentation. That was one of the best presentations that I have ever seen. So that was just totally mind-boggling, because I think he embodied everything that a person is looking to start a business, invest in a business, what it all looks like, and give you a really good sense of how it actually feels. And I hope I was able to add a little tidbit here and there to something that was very beautifully put together and very beautifully done. It was really awesome. Thank you guys. Can't wait to see you guys again. Please don't forget, tell a friend and tell another friend.
You've reached the end of another episode of the Minority Business Access Podcast. Connect with us at solomonrcali.info to leave a review and access more resources. We hope you enjoyed this show and found great value. See you at the next episode.